right, we're back and we're gonna wrap it up as if you had just gotten an accepted offer on your dream home. What do you do next, right? There's a little bit of more vocabulary we wanna share just so you have, set expectations of like, okay, now we're locked and loaded. What do we expect next? So let's talk about escrow, which basically means what?
So escrow, basically, you'll hear the term a lot. You'll hear that during your transaction. You'll hear it even after your transaction too. But escrow simply means a neutral third-party account. We utilize escrow companies here in the state of Hawaii. And what they'll do is their job is to keep your money and also enforce the contract. In most markets, but mostly here in Hawaii, the purchase agreement is very buyer friendly, right? And can you kind of point out like a couple of milestones as how it could benefit the buyer?
Absolutely. And just before I do that, so it's hand in hand that title company and escrow company are the same thing. So a lot of the times my clients will be like, what's title and what's escrow? And I'm like, oh, backtrack, it's the same thing. So just clear that out. If we use the vocabulary of both, it means the same thing. But yeah, once you got an accepted offer, now there's a couple check boxes we got to get through, make sure that everything's like it is, it's safe, it's sound, we still love the home. So first one's going to be your home inspection. That's the biggest one, and we call that J1. But typically you're going to have a professional home inspector come in, look the place through top and bottom. If we can't agree on repairs or any changes that need to happen, we could potentially cancel, or we just inspect it and we don't love it anymore. That can happen too. Next one is going to be typically your appraisal, which is a big one for the lender, like we talked about. So it has to appraise at value. It can't be worth $200,000 less than what we're offering on it. Like it's got to make sense. That's a kick out if you need to. Another big one's going to be termite inspection here in Hawaii, right? We have these bugs. It's tropical. Termites are everywhere. So we want to make sure that passes clean. If it doesn't, the seller's responsible to do those repairs or mitigation. But again, some people just have cold feet about termites. They're like, nope, don't want to even mess with it. I'm out. We talked about condo documents. That can be another big one. Let's say, like we said, it's not fully insured, or, I have a Great Dane and there's a pet policy for 50-pound limits. Something like that comes up, you can absolutely cancel. But for the most part, it really does protect the buyer to cancel. On the listing side, if a seller wants to cancel, there's got to be something else going on, really. If they're doing their job and we're checking each box, it's really hard for the seller to cancel legally.
Yeah, it has to be something major that was not disclosed, or the financing doesn't come through, or something like that. So for the seller to cancel, it's very difficult. For the buyer, you have those multiple milestones, the contingencies as we call it, that you can utilize to get out of the contract, get your deposit back. Now, coming back to J1 or the home inspection, one of the things I always talk about with my clients is that it is entirely optional. However, very highly recommended. It is your one time, it's usually a few days, maybe a week, where you can do your due diligence to make sure that everything is in working order and it's still up to your liking. And once you pass that, then the other contingencies, yes, you can utilize that, but it gets a little bit harder. You have to point out a defect in the title or the condo documents, or something else, and say, hey, I want to cancel because of that. Whereas J1, that first week or so that you have, you can cancel for any reason. You just say, I don't like this or this about it, and you can cancel. So, just make sure that it's anywhere from $400 to $600, maybe sometimes $700 for a home inspection. It's not a requirement for the loan. Therefore, you do have to pay for it out of pocket, but it's well worth it. You might be able to find a major problem, that was just right behind the walls, whether it's plumbing or electrical.
Yeah, and just to go back to timeline, so how much time do we have for each thing? It's going to be clearly listed out in that offer, so before we even submit it to the seller what you're signing up for. Same thing for how long does it take to get keys. We're going to say specifically in our offer, we can set that timeline. Seller has to agree to it, but as the buyer, you can say, hey, I want to close in 21 days or 45 days or whatever works best for you. So just realize there's lots of flexibility there, but you're going to get to see it and initial sign it all before it gets submitted to the seller first. And then we can say, okay, we're at the end, we're supposed to close, but now we need to extend. Sometimes that happens for a couple of reasons. Maybe we're waiting on the bank for something, or maybe the seller needs an extra week to move out. We have the right to extend that if needed, but for the most part, all parties are going to push for that close date as it should be.
And then also some of the things that you might be, wondering is like, okay, well, if we close today in March, then, when is my first payment going to be? Typically, your first payment is going to be on the first day of the second month after you close. So let's say today is April 8th and we close today. We get our keys. then your first payment would be not May, but June 1st. And whenever we look at mortgage payments, your mortgage payment is always looking a month back. So your June 1st payment is actually looking back at the month of May and accounting for that. And that's how you'll pay moving forward. It's a little bit different from paying rent, where you pay the month moving forward. So you pay on the 1st and that covers you for the next 30 days. For a mortgage, it's kind of retroactively looking.
Yeah, which is a good, I'll just say like asterisk, save this part of the video for future, because a lot of people think I have to wait to offer on a house till I can move in that month. No, because your first payment isn't going to be due for potentially 2 months after you close. So if you want to start shopping now, go for it. We can help you reverse engineer that timeline too, if we're worried about double payments and stuff like that.
Absolutely, yeah. And you know, you definitely want to be creative, and you know, there is some flexibility. So, you know, you definitely want to have that conversation up front saying, hey, when do I want my first payment to be? How do we reverse engineer that? For sure.
So let's say you've closed, you own the house now. Okay, fast forward. What else do you need to know to kind of plan for the future? Because I think, like I said, it's not that you need to know it immediately, but like there's other tools with real estate you can use to help build wealth. So let's talk about like one like HELOC.
Sure, yeah. So there's so now that you're a homeowner, you're on this new journey and chapter of building equity. And that's what this whole video series was about, was how to get you a position and so that you can start building equity. But now that you're in that position, you know, what can I do? So there's different tools that you can utilize. One tool is called a HELOC, which is home equity line of credit. And what that does is that it kind of turns your home into a credit card, and you can start financing other things using the equity of your home. If you can imagine like a big maple tree, I know we don't have those here in Hawaii, but just use your imagination, a big maple tree, and it has really sweet maple syrup or maple juice that you want to make into syrup. Now you have to tap into the tree with like a spigot, and you know, make a little hole, so then you can start, you know, getting the
drain a little bit.
Exactly. So you can start, you know, giving it an outlet so that it can produce the maple syrup, right? So that's the same concept. The equity is locked in your home, and we have to find ways that we can basically turn the faucet on, but we gotta screw in the faucet first. So one way is going to be that HELOC. Another way is what's called a cash out refinance. And that's, you know, basically doing a new mortgage, but you're cashing out on the equity portion.
Okay, so the clock resets to 30 years again? Is that how it is?
Okay. But depending on the bank and the lender, they can still keep the same. Let's say you've been in your home 3 years, so you have 27 years left. You can still say, I want it to be a 27-year mortgage. So there's some flexibility there too. So those are some cool ways that you can tap into the equity of your home. So, you know, you might want to start thinking about that maybe a few years, you know, especially if you've done a low down payment or you've done zero down payment, then it's going to take some time for you to build equity. So it might take a few years, maybe 3, 5, maybe 7, 10 years, who knows? But have that big picture in mind, because, you know, that's the whole point of, you know, purchasing real estate, is so that you can start leveraging that equity to fund your dreams, fund your goals.
Yeah, and I would just say here, like, just be wise about it. It's not like we're gonna go tack on extra debt just because you can. Hopefully you're borrowing it to go make more money with it. So whether that's renovating, whether that's, you know, investing in more properties in the future that's gonna cash flow, just be smart about it. But I don't, like, for a lot of people, I don't think they know, where do you go for a HELOC? Do you go back to you? Where do you get the loan?
Yeah, so definitely the first place that I recommend my clients to go to is come back to me, and let's have that conversation. Now, I will be completely transparent, and your local banks and credit unions typically have the best rates when it comes to HELOCs and the best programs. But we want to also make sure that, you know, there's, you know, your profile, you know, there's no like irregularities or like something that it makes your situation very unique that a local credit union or a bank might not be able to do. Also, speed is another thing, right? So the local banks and credit unions, they can take 30, 45, 60 days just to do that HELOC. Okay. Sometimes faster, but you know, they can take a little bit long, and it might be a little bit more of a tedious process. Whereas if you, let's say if you need the money fast in the next 5 days because there's something coming up or there's an opportunity, then there are certain banks that we've partnered with that allow us, you know, to get the funds from application to funding in as fast as 5 business days. So, it just really depends on your situation. That's why I always recommend come talk to me first, or go talk to your, trusted mortgage broker or loan officer first, and then get all your options, because they'll know your story if they did your first loan.
Sure. Yeah. And just again, it's like another third-party checkpoint to be like, should I be doing this? Is it a good time? Is it not a good time? And Brian will be the first one to tell you yay or nay, should we do this? And then do you recommend opening one just to have one? Because you don't owe money if you don't use it, right?
Correct. So for HELOC, it's kind of like a credit card. If you have it, but you don't have a balance on it, you don't have to make a payment. So, for every homeowner that gets into a home and they're at that point where they can open a HELOC, I highly recommend just go and open it up. Even if it's a $10,000, $20,000 credit line, or, $100,000, whatever it is, just go open it up. Have that as a backup plan, in case you have medical expenses or an accident or something happens and you need to access that cash. It's better safe than sorry. Have that open as soon as you can. Typically take about 3 to 5 years to get to the point where you have enough equity to make it worth for the bank to open up that line of credit. But sometimes it can be sooner, sometimes it can be longer, but as soon as you get that opportunity, that next step is to have a goal to open up a HELOC and have that available for you.
Okay, also is taxes, right? We got to talk about that. Now that you're a homeowner, how does that change your tax implications and all of that? I think biggest thing is you get to write off your mortgage interest, which is the majority of your payment in the first couple of years. So that's a big one. Any notes on taxes?
Well, obviously go talk to a CPA or a tax professional, because every individual, every family is gonna have a different tax situation, different income situation. So definitely go talk to a CPA. However, yes, what Marina said is true, that the interest portion on the mortgage that you pay, and especially also that first year after you close. So if you close this year, when you file for taxes for 2025, next year, the points, the discount points, the money you spent buying down the interest rate, even if it was funded through seller credit, like we talked about earlier, that is still your benefit that you can deduct and expense out. Because technically you are paying for the points. It's just that the source of the funds came from the seller, but it's technically a borrower paid item. So typically you'll receive a form called a 1098, 1098, IRS form 1098. We call it 1098s. And on that, it'll list how much total interest you paid that calendar year. If there's any discount points that you paid, it'll also notate property taxes, things like that you might have paid, throughout the course of the year. Hand that to your CPA or upload it to TurboTax, and then you should be able to, calculate what your tax benefit is. Now, from my knowledge, owning real estate, having a tax advantage, the US, I think, is the only country that really has that codified into our tax law, into our IRS code. So definitely take advantage of that. One of the things that I always provide, especially for those who are going from renting to buying their first home, is a rent versus purchase comparison, where we look at also the tax advantage, the tax benefit. It is estimated, but based on your income, your tax bracket, whether you're single or married, things like that, we can kind of, create an average or an idea of what that tax benefit might be. So we definitely want to make an analysis on that first too. So let's also talk about appreciation, since that's very tied in with the HELOC or cash out refinance opportunity that might come up. Know your market, whether it's an appreciation state or appreciation market, or whether it's a cash flow market, and make sure that, you keep in link with your realtor at least once a year, so that they can do what's called a CMA. What's a CMA?
It's comparable market analysis is the technical term. But basically, I'm just looking at the sold homes in your neighborhood specific or your building specific to say, based on today's value, your home has gone up to XYZ. Maybe it stayed the same. Maybe it's gone down slightly. Like I said, in the very beginning, this very first video, we talked about appreciation. Goes up and down like the stock market, but on average, Hawaii's about 5 to 7% a year. So ideally, we're seeing that value go up. And then maybe we can say, okay, it's been 30 years, your home's gone up in $100,000 in value. Maybe that's your green light to go get that HELOC then, right? but it costs you nothing to send me a text and say, hey, what's my value at? I can literally go check. There is a thing called Zestimate on Zillow, but Zestimate pulls from a way farther than your home specifically. So it's really important to go to me specifically or your realtor of choice specifically, because we can get really granular and just more specific for you.
And like how it costs no money to talk with Marina or your realtor to get that CMA, it also costs no money to talk with your mortgage broker, loan officer, or me to talk about, okay, now we know what that estimated value is. What are the options? Can I do a HELOC? Can I do a cash out refinance and all that stuff? So really knowing appreciation, and especially in your neighborhood, is going to be very important. So, definitely always keep an eye out for the different open houses that are going on, and you'll start to kind of investigate, and it becomes a fun game to see.
Yeah, so you can gamify it.
Yeah, exactly. How high your property is valued, or how it's appreciating.
Yeah.
Okay. Yeah. The last thing is that it never, like we just mentioned, like it never costs any money to talk with a licensed professional like myself or like Marina. And we are here to give you objective, transparent, data-based information, to help you achieve the dreams that you've had of homeownership. So
yeah, and it's just a reminder that once you close and you own the home, it's not like our relationship dies and we never talk again. That's like the last thing that I want to happen. So I even just had a client the other week, and he's like, can you remind me where the disposal switch is? And I'm like, yes, I'll he's first time home buyer, doesn't know, And so just little things like that. Or if you want to know, like real quick snapshot, hey, can you pull comps? Or like, what if I were to rent it out? What's the rentability of my home right now? I can whip it up in 5 minutes, guys. Like it's literally so easy.
Yep.
And then what if job changes, or I'm pregnant now, what can we do? Like ask me all the things. I want to know what's going on in life so that you can make educated decisions. Like that's the point of this video. That's the point of the future. So you can do better at adulting. Like that's the whole point. Yeah.
And I'll share a quick story about a past client. I had a past client that bought in 2021. And we had some really great appreciation in 2021, 2022. And so with the equity that they were able to build up as first-time home buyers, 4 years later, now they have enough equity that they're going to do a HELOC, and then they're going to put another down payment on an investment property and buy that second property. So, it took them a lot less years and time than that they had projected to start building their real estate portfolio. So it's definitely possible for you as well.
Yeah, and just our personal stories. We bought one, lived in it for a year, bought the second, lived in it for a year. Now they're both investment properties. So it's like, the sky's the limit. What do you want to do? We'll reverse engineer it for you and help make it a possibility.
And we always say, if you plan to fail, fail to plan.
Yep, we'll put that in all bold for you.
No. If you fail to plan, plan to fail.
Wait, redo.
Okay. And like we always say, if you fail to plan to fail.
Yep, so don't do that. So we hope you enjoyed this whole video series. It's really just important. I wish more people knew this, and our clients always tell us, no one ever told us growing this up, or our parents didn't teach us this stuff. So watch this, share it with friends, share it with family that's also in a season of life of trying to build wealth through real estate. And most importantly, reach out. Don't be a stranger. You watch this video, engage with us. Comment below. We've got our contact in the description below too. We want to have conversations. It's really easy to hop on a Zoom call and just map all of this out and have like the biggest roadmap for you for the future. So thank you so much for watching, and we'll see you soon.